Welcome to the $64,000 secret to retiring decades early. In this video, we'll show you how a one-time windfall can radically accelerate your path to financial independence. First, we'll set the mindset and foundation. Next, we'll lock in tax advantages. Then, we'll deploy the remainder into a simple, powerful index strategy. Finally, we'll cover behavior, automation, and compounding so you can turn today's cash into tomorrow's freedom. Receiving a large windfall early in your career is not a license to inflate your lifestyle. It is an unmatched acceleration tool. When used correctly, it can shave years, even decades, off your working life. In this episode, we'll pivot away from slow saving and toward aggressive, high-impact capital deployment. We'll walk through foundation, tax-advantaged accounts, market exposure, and a behavioral framework designed to keep you consistent for decades. This video is for educational purposes only and does not constitute financial, legal, or tax advice. Your situation is unique, and you should confirm current IRS contribution limits, employer plan rules, fees, and any tax implications with a qualified professional. Investment returns are not guaranteed, markets are volatile, and you can lose money. Use this as a framework and tailor it to your own circumstances. Here's our roadmap. First, we'll adjust your mindset from spending to acceleration. Next, we'll solidify your foundation by eliminating high-interest debt and protecting your emergency fund. Then, we'll maximize your tax-advantaged runway with Roth IRA timing and 401k front-loading. After that, we'll direct the remainder into a simple, low-cost, diversified index strategy. We'll also lock in the behavioral edge, treating the windfall as if it never happened. Finally, we'll end with an action plan, a couple of quick quizzes, and key takeaways you can implement today. When a large windfall lands, the immediate temptation is to spend. Instead, you must view it as fuel for compounding. The goal is to convert a one-time event into a permanent advantage. The flowchart shows the decision path. Assess and pay off any high-interest debt first. Verify your emergency fund remains intact. Then, maximize tax-advantaged accounts. Invest the remainder into a low-cost broad index fund. Automate ongoing contributions, live as if the windfall never occurred, and ignore market noise. The boring, diversified approach tends to outperform most complex or emotionally driven strategies over long horizons. Use only about 1% for a small treat to satisfy the psychological urge, then deploy the rest systematically. First, eliminate all high-interest consumer debt because it compounds against you at double-digit rates. That interest is a guaranteed drag on your net worth. Next, protect your emergency fund in a high-yield savings account. Do not invade it for investing. Liquidity prevents small life crises from becoming large financial setbacks. Stability is your primary risk control. The market can wait, but emergencies cannot. By securing your base, you ensure that your investment plan survives real-world surprises. Quiz time. Question: you receive a windfall, already have a healthy high-yield savings account, and carry 19% APR credit card debt. What is your first move? Option A. Invest it all into an S&P 500 index fund. Option B. Use part to pay off the credit card immediately. Keep the HYSA intact. Option C. Drain the HYSA to invest more aggressively. Option D. Buy individual dividend stocks for income. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to use part of the windfall to pay off the high-interest credit card immediately while keeping the emergency fund intact. High-interest debt is a guaranteed negative return, so eliminating it is the best immediate use of capital. The HYSA should remain untouched to preserve your stability. Next, widen your tax-advantaged runway. If you've already maxed your Roth IRA for this calendar year, plan to contribute for next year on January 1st, subject to the current IRS limit. Confirm the limit, because it changes over time. Simultaneously, increase your 401k contributions now, and use the windfall to subsidize your living expenses while your paycheck deferrals rise. This lets you front-load contributions, maximize any employer match, and benefit from tax deferral as early as possible. Also, review plan fees, match schedules, and investment choices to ensure efficiency. This illustrative table shows how one might allocate a $64,000 windfall. Use about 1%, roughly $640, for a symbolic treat. Allocate what is required to eliminate high-interest debt. Keep your emergency fund in place. On January 1st of the next year, fund the Roth IRA up to the IRS limit, confirming the current maximum. Increase your 401k deferrals now to front-load contributions while using the windfall to support living expenses. Direct the remainder, likely over $50,000, into a low-cost, broad-market index fund. All figures are examples. Always confirm current limits and tailor the amounts to your situation. Now deploy the remainder for growth. Choose a broad market index fund or ETF, such as a total market or S&P 500 equivalent, with very low expense ratios. Automate monthly purchases rather than trying to time the market. Consistent contributions and diversification, combined with low costs, are the most reliable levers you control. Avoid specialized stock picking or chasing dividends. Simplicity tends to outperform complex strategies due to behavioral and fee advantages. This pie chart illustrates an aggressive allocation suitable for a long time horizon, with approximately 90% in total market equities and 10% in a bond or treasury buffer. The equity portion drives long-term growth, while the smaller bond slice helps with volatility dampening and psychological comfort. Investors should adjust these weights based on risk tolerance and rebalancing policy. Here is a concrete sequence. Day 0. Take inventory of debts, emergency fund level, existing accounts, and employer match rules. Day 1 to 2. Eliminate all high-interest consumer debt. Day 3. Confirm your emergency fund target and keep it liquid. During week 1, increase your 401k deferral rate and map your living expenses, using the windfall to bridge any shortfall from higher paycheck deferrals. In week 2, automate recurring purchases into your chosen index fund. On January 1st of the next year, make your Roth IRA contribution immediately, verifying the current IRS limit. Each quarter, rebalance if needed, review fees, and recommit to ignoring noise. Second quiz. Question. According to this strategy, how much of the windfall is earmarked for a non-essential self-treat? Is it 1%, 10%, 25%, or 50%? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 1%. Using a very small portion of the windfall for a non-essential treat helps satisfy psychological urges without undermining the compounding effect of investing the rest. Finally, the behavioral edge. Treat the windfall as if it never happened. Invest every other dime after the minimal treat. Resist lifestyle creep by avoiding new recurring expenses. Unsubscribe from distracting commentary and automate your plan. Review quarterly to verify contributions, allocations, and fees, but otherwise let compounding do the heavy lifting over decades. This timeline uses the Rule of 72 to illustrate how an initial remainder of roughly $50,000 could double approximately every 9 years at an 8% nominal rate. It shows potential doubling around years 9, 18, 27, and 36. These are illustrative, not guaranteed. The point is to emphasize the power of time in the market. Starting early with a substantial lump sum creates meaningful acceleration toward financial independence. Here is a quick comparison. On the left are behaviors that reinforce your plan. Eliminate high-interest debt, protect your emergency fund, use tax-advantaged accounts early, invest in low-cost broad index funds, automate and ignore market noise. On the right are common pitfalls. Chasing hot tips or timing the market, raiding your emergency fund to invest, inflating your lifestyle with new recurring costs, relying on stock picking or dividend chasing as a core strategy, and neglecting fees or plan rules. Focusing on the left column behaviors increases the odds you will reach financial independence sooner. These are the core takeaways. Use the windfall to accelerate, not inflate, your lifestyle. Eliminate high-interest debt and keep your emergency fund intact. Maximize tax-advantaged accounts through early Roth IRA funding and front-loading your 401k. Invest the remainder in low-cost, diversified index funds. Allow yourself a small symbolic treat of about 1% and invest the rest. Finally, automate contributions, ignore noise, and let compounding work over decades. To wrap up, act today. List your debts, confirm your emergency fund level, and increase your 401k deferral rate. Put a reminder to fund your Roth IRA on January 1st next year, verifying current limits. automate index fund purchases, and set a recurring quarterly review. Most importantly, live as though the windfall never occurred so compounding can do its work. Here is a concise 3-line playbook in Markdown form that summarizes the approach. Use it as a quick reference to keep your actions aligned with the strategy. This quick reference playbook condenses everything. 1. Secure your foundation by eliminating high-interest debt and protecting the emergency fund. 2. Expand your tax-advantaged runway by funding the Roth IRA early next year and front-loading the 401k. 3. Invest the remainder in a low-cost total market index fund, automate contributions, and ignore short-term fluctuations in commentary. Thank you for watching. If this video helped you turn a windfall into a long-term advantage, please like, share, and subscribe. Drop your questions or your own windfall game plan in the comments. What would you do with $64,000 to retire decades early? I look forward to reading your strategies.